manager, CEO, also the managing partner, Thomas Hulick. And, you know, it's pretty amazing to me, right? Because you'd already said, listen, this has been somewhat orderly, although beneath the surface there have been pockets of this market that have gotten hit. And so what do you make of today's reaction? I think the instant reaction just kind of, so I've been saying this is a coiled spring for a while.
Well, I agree with you on the coiled spring. We've been optimistic on the market for actually a couple of years now, but when you see, and this market is definitely headline driven. There's so much volatility, and especially when Trump speaks, you get a snapback when we had oil peaking above 100 and now it's back into the $80 range. You know, what's next? What's next for us? A lot of volatility though.
Now there are some are saying, hey, we're also, you can argue that we're in a rolling bear market if you look at some of the sectors and niches like software. Some of those names have been hammered. Obviously, anything associated with private credit's been hammered. Do you think maybe that's something, because individual investors' anxiety is really up there. Bear sentiment has gone through the roof, and it doesn't necessarily match the drawdown that we've had so far this year.
Yeah, I don't necessarily agree that we're in a rolling bear market. I think you've got to go back to where we were before the war started. Earnings were still positive. Interest rates were on the way down. We have a lot of positive tailwinds in our back. So I disagree on that point. I think we're ready to explode. If this conflict settles down, we're off to the races in the market.
I'm going to put up a chart. We have a chart here for the audience. It's really interesting. U.S. stock market returns since 1928 to 2024. So when inflation is rising, up 4.3%, and when it's falling, up 15.2%. Rates up 9.3%, falling 9.5%. This whole thing seems to be really the most interesting thing here is with the respect to inflation. Could this thing be resolved soon enough that there's not a real inflation blow?
I do. I think that if oil stays above $100, all bets are off the table. But the Trump administration has been very transparent with what they want to do with settling the war as quickly as possible. With that being said, and you have oil come back down to a normal, it won't be as much of a stress on interest rates being increased.
Right.
It'll actually probably.
Would that bring rate cuts back into the picture for this year?
Oh, for sure, for sure. I mean, over the weekend on Friday, we had the possibility of rate cuts or rate hikes happening.
Right.
And now we're talking about rate cuts. And so it's just the stability of the interest rate market that we focus on as an active manager.
So Thomas, cash on the sidelines. I know I saw your note, you talked about cash coming in or cash on the sidelines. Right. We've been talking about cash on the sidelines for a long time. So money markets, this is amazing. So you had $3 billion in retail, $4 billion, almost $5 billion in institutional money last week alone.
Yeah.
Billions rather, go back into money markets. They're approaching $8 trillion.
$8 trillion.
It feels to me like, I assumed that interest rates would come down a little bit and people would rapidly get out of those and find another place to invest. Maybe the money stays on the sidelines.
Well, with $8 trillion on the sidelines, it sends a signal for us. We think that the market is really prepared for the next generation cycle that we're seeing. But it's very positive for us to see that right now, and we think that we're just in a rotation period, right. Very cyclical, and it's gonna take off very soon. I'm glad that we have that much cash because that signals to me that things are going to be good on the ahead of us.
AI infrastructure, data center demand, you like Sienna and Corning.
Corning, right? Yeah. So picture Corning as essentially building the highways, and then Sienna is somebody who's directing the traffic. Both are complementary to each other in the AI infrastructure build out for power transmission and fiber optics. And if we get to the 5G world, wants the 5G, we'll
right.
be there, but there's just a lot of positive in the data centers.
Isn't it remarkable? I remember these were hot names and then they weren't hot for over a decade.
Right.
If you hang in there long enough, your time may come back around.
Sienna's been a great pick for us, and so is Corning. We've really taken the shift and a broadening of our portfolio, and these two have really been outstanding for us.
Which brings me to Disney. Coming out of the pandemic, everyone said it was a layup. We were pent up. We wanted to go out. They had the theme parks, the movies. They had it all.
Yep.
And yet the stock has done nothing, zero. You think now's the time to buy it?
I do. I mean, layup is good to talk about during March Madness. And there's a lot of excitement with the ESPN, but if you think about the theme parks, cruises, the streaming, and then you build in the sports and the ESPN, I really think that Disney is positioned itself for this next leg. And with the change of the CEO from Bob Iger leaving out, he set things up very nicely for Disney.
Well, I know he set himself up pretty nicely. He made a lot of money during that tenure.
He did.
All right, great seeing you, my man.
Nice to see you,
Appreciate
Charles.
it.
Thank you.
All right, folks.